Good morning and welcome to Trade with Conviction. It's the 25th of June and we're recording at 10 in the morning Geneva time. I've got June and Abhishek with me. How are you guys?
Hi everyone, I'm doing good. Fresh from my holidays from China.
Hello everyone, yeah, I'm good
Very
as
good.
well.
Did you notice anything interesting about the state of Chinese oil demand, June?
Well, I was trying to uncover hidden barrels, like what we were all pondering about. Didn't see any. I did see a lot of EV cars, just that it's not 100% EV cars. And one interesting fact that I uncovered is why Beijing has less EV cars than south of China is because of the winter effect, where there's lower battery life for EVs currently with the current technology. But once they get overcome, then there will be even higher penetration of EVs in the north of China.
Well, and plenty of incentives have been around to try and increase that. I think the same thing is happening in many parts of the world. European EV sales going up. One of the more medium-term implications of what's going on. But talking of miracles, let's say, we have Brent and contango, at least at the prompt. We didn't really expect that. Did you guys see that Brent might actually be in contango?
No way at all. I mean, when I was away, Dubai is like also went into contango. I think that surprised me and many of as a market analyst. But even now, Brent going to contango. I mean, what do you see?
Yeah.
What do you see this, Neil? What's your read of it?
Well, it's a continuation of this massive sell-off, right? So I don't think anybody really believes that this is the stable picture on price for the next few weeks or months. I mean, there's no stable picture in the flows that we can expect out of Hormuz or the politics. But let's say the picture today was stable for the next couple of months. I think we can agree probably contango in Brent is not fair value. However, we've got many moving parts. We've got obviously this dynamic of the sell-off. So, longs getting absolutely battered, people increasing their shorts, there's CTAs going on, there's algos, there's all this kind of stuff that feeds into the mix. And then on the fundamental level, we've got investors, traders generally extrapolating the picture forward. So the picture is we're getting more exits out of Hormuz. We have a bunch of floating storage, essentially. We've got laden and unladen tankers that were trapped in the strait all this time. Some of those are now exiting, and we're getting an extrapolation of that forward, right? Basically saying, okay, we're going to have plenty of supply. Whether or not that turns out to be true, whether or not we get sustained peace, whether or not we get a deal, it's all up in the air. And of course, one of the main stories is, are we going to get enough tankers into place to make all of these supply gains realized? So we had quite a few announcements over the last few weeks. Kuwait ramping up supply, Iraq ramping up supply. We don't know if we can sustain some of those things yet. And there actually was a piece of news that West Kurna too was needing to be shut back down again, so to speak, or at least rolled down because we didn't have the tankers available. So there's lots in play. And there is also sort of US job owning continuing, right? So I think the US administration came out with, I think there was a number of 18, 19 million barrels per day flowing out of Hormuz, which I don't think is a statement that we can really make at this point in time. And the other thing,
I think the chart I saw is really much lower than even like 16, right? It's really, really much lower than the number that they're touting.
Yeah, I mean, it's going to be choppy data, but I think that it seems like the sort of barrel per day count over the weekend and the last few days has been quite high. And if you add in, Yambu incremental and stuff like that, you can get to some quite big numbers. But the question is all whether it's sustainable. So I think that is just, one of the risks we have to think about over the next few weeks. And of course, this week there was, I think, what's also seeping into Brent a little bit is just this notion of macro risk. So I think the macro risk is sort of rising this week, and one of the sort of triggers of that was South Korean equities for a few different reasons. But I think the market is picking up on some of that, and you can see it in the positioning data from last week. Actually, the number of short that are now on Brent is actually quite large, and so on a net basis, it's now quite interesting. That hasn't filtered through to the products yet. So if you look at ICE gas oil, we're still actually relatively long, and in something like RBOB, very unusual situation, sort of ratio of longs to shorts is very unusual. There's basically no shorts in RBOB, so we've still got this divergence of crude versus products. So what do we think? Kind of wait and see how it plays out.
Yeah, I think we started this whole crisis already knowing that it was products that is the stress barrel. And when you look at the normalization pattern that we anticipated. Crude will always be the first to recover, and now we're going to see the effects of whether we have enough refining capacity to meet the demand for summer, and whether the replenishment that people talked about is that really going to play out in this hot summer? We shall see.
Yeah, we got some of that risk turning up already in Europe in terms of the heat. But on a general level, I think that's true. And just on the widest possible level, what we're doing now is we've spent 3 or 4 months getting rid of seaborne oil demand, right? And the key case in point of that is SPR draw in the various different locations, and something like Chinese crude imports. That's the most obvious one to pick up on, but there's lots more around the world. And now what we're doing is we're extrapolating forward this big spike in physical demand and in physical supply from the AG, and demand is yet to catch up. So I think that's something we all need to be wary of as well. There's massive moving parts on the demand side. And here I'm using demand and imports interchangeably. And so those two things are going to be in a bit of a battle as well. And at the moment, supply and the notion of future supply is winning versus the demand side. One more thing I wanted to talk about, the Jody data. So we got Jody for April. Obviously, it's kind of retrospective, but there's some relevant things in terms of the starting point for normalization ahead. And a couple of things that were borne out in the rumors and some of the early data. European gas oil demand was very poor. We're looking at, case in point being France, where you had this massive reduction in gas oil demand year on year. I still think there's a suspicion that a lot of this is kind of delayed demand, particularly on the heating oil side of things, which will come back. And, we also got Korean nat stats, for example, showed a big drop. And I think there's similar dynamics going on there. A couple of things on jet demand. European jet demand seemed decently strong, surprisingly. Maybe it comes off a bit more in the May and June data, and gasoline demand actually stopped growing. So Europe's been on this constant growth path for gasoline demand, partly on de-dieselization. And in April, it didn't grow at all. So there has been some demand effect to see already on the gasoline side in Europe. The European jet yield was big. I think we all expected that, basically to mirror the US side of things. And European product stocks were actually not that low. I have to say that didn't look like they changed that much. So it's an interesting, we kind of suspected that internally on and off, but it's an interesting starting point for us now, because do we need to normalize European product stocks in the same way we do need to normalize the US side of things? Because we can obviously see the US product stocks are low. And it's almost the same on European crude stocks. Didn't look that low. The crude stocks that were down very heavily was OECD Asia, and that was despite their big run drops. So I think there's the notion that Asia had a problem. Europe had a much less of a problem on the inventory side, partly due to demand. And the US side is also still very tight and needs to try to normalize. Anything else on that, guys? Going on a bit of a rant.
We saw some pictures about ARA stocks being low. So I guess it's really a localized impact on ARA, but the broader Europe was fine, right?
Yeah, I've been wondering about that. We've been talking about that internally a bit. Why would ARA jet stocks look so low, for example? And one thing that's going on is you've got these big changes in imports and exports into the hub. So that might be influencing ARA in a different way to the rest of Europe. Plus, in the rest of Europe, you have refineries that are also they're all trying to produce more jet for the local market. So you may be influencing the sort of cross-border trade in Europe as well. But yeah, you can always run into these situations where the ARA stocks look different from the rest of Europe. And also, I know from the past that the high-frequency ARA data can look different from the national statistics for the relevant countries. They're Belgium and Netherlands. So you can get these divergences as well. So yeah, limited. We've always got data issues. Okay, let's go for crude and refining. June, tell us about the crude market.
All right. I titled this week's snippet and pod the Asian crude buffet. It seems unbelievable compared to where we were 4 months ago. We basically saw, number one, crude Dubai swap spreads went into contango. July, August, probably now like minus $120, 120 cents per barrel. Yeah, and I don't know how long can this contango last. Neil, you got anything to talk about that point?
No, I just wonder if this is one of the key opportunities. You got Dubai swaps -1, more than -1. That just seems too weak. We're going to have this drawdown of floating storage out of the AG, but now we've got flat price at 72. Surely we got people roaring back into the market, and the key one is obviously China. Surely Chinese demand picks up. If I had plenty financial backing, I would be grabbing all the cargoes I could possibly get. And it just feels like a lot of this price action is now massively oversold, and look at Dubai swaps -1. It feels like a buying opportunity.
Okay, I'll talk a bit about the restocking part in a bit as well. But anyway, for now, it's all about the current trading window, which is in June, we are buying for August, and we are now close to the end of the trading window. So we are now seeing basically Asian refineries already bought enough for August, and you got now incremental oil coming out from the Strait of Hormuz prompt, which can arrive within 14 days or so into the 14 to 21 days into the Far East. So that creates that mini overhang in this prompt trading cycle. And we don't have China there to pick up on these incremental barrels. We've seen Murban crude premiums. They've dived to by almost $10 per barrel in June. Now it's about minus 80 cents. So much so that the ARBs versus 40s was open into Northwest Europe, even with the Brent Dubai EFS at $6 to $7 per barrel. We had the extra crude oil coming from ADNOC. There was 4 crude tender releases now for UZ, Murban, and DAS. The latest one is for loading in June and July. That further depressed the market. Latest of the latest, Qataris are also in the game. They have sold Al Shaheen, Qatarland, and Qatar Marine for August deliveries. And even Iranian crudes are given free rein now, right? The waiver has come for 60 days at least. But who wants to take this risk when there is plentiful of oil for the immediate requirements for the refineries here in Asia? Even India, which has only a 3-day journey from Iran, looks to be staying out of the Iranian trade for now, because I'm hearing that there are concerns on whether they're going to use the fleet for the Iranian barrels where they were using the dark fleet before. So all this thing basically shows that the confidence of using Iranian crude is very low. It will likely stay mostly in China until there's clarity that the peace is lasting and the sanction relief is permanent.
Can we think about so what could be the short-term solver for this prompt glut kind of thing? So what you talked about, sort of very, very short delivery times. What about, for example, the Indians? I mean, they've spent the last few months taking a lot of view rolls. I suppose they're relatively covered for the next month or so anyway, but do you think that the Indians would be tempted back to the PG market and save themselves a bit of, political trouble in picking up too much Russian? Is that a possibility?
I always find Indians are quite economic in decision. So if we are seeing now the ARBs are wide open for, shut for all the arbitrage crude. So we don't model Russian in our case, but I can imagine it will be the same thing. And they will definitely want to find the cheapest barrel, which is probably the AG barrels. I don't think they will totally shut out the Russian oil. Abhishek, you can correct me if I'm wrong as well. But there will obviously be a strong incentive for Indian refiners to now ply back into the AG trade.
Yeah. And the same surely true of the Europeans as well. Their sort of procurement cycle is slightly shorter than the Asians, obviously. And there's talk of Murban coming to Europe, and that's partly the thing that's depressing the North Sea diffs. And one thing I think we should also think about is this question of quality as well. So it was partly for quality reasons that the Asians weren't cleaning out the North Sea market at the beginning of this crisis and the WAF market. And the reverse might also be true, that the sort of Asians and the Europeans want to have the right quality. They're all residue starved. And Europe is one of the places which might end up taking more PG in the short term. And the thing to remember on that is as well, the TI Afra ARB is closed in Europe, and it's been more closed more often over the last few weeks because of the US stock situation. And so a natural thing, logically, based off that, is we take less TI into Europe and we end up pushing a bit more PG into Europe, which partly helps to clear some of this glut in the initial stages, maybe.
So I think, indeed, the solver is one, if you go to Europe. The second one is that is why Dubai is going to contango. It will then also go into some kind of storage econs, at least for the short term. I think it's more the demurrage impact, because from an Asian refiner, if you want to put in the barrels for August, you need to carry the cargo. The econs will make sense in terms of demurrage rate to carry that cargo all the way until you can actually fit it into the refinery. So that solver is currently with the Dubai swaps remaining there in contango, at least until we resolve this prompt overhang. And then maybe post AG, when the dust all settles, I'm thinking that from a mass balance point of view in Asia, we won't be at the same point as we were pre-crisis. You will see less AG in the diet, in the base diet. There will be maybe 5 to 10% marginal switch into alternative crudes. For example, Korea already has kind of committed to more TMX crude. And that I don't think they will just want to switch out because of immediate flow now from the Strait of Hormuz. So we then see that 5 to 10% of displacement of oil needing to go somewhere else, which means the arb into Europe can be more open than usual post this whole crisis happening. And basically, prices also will need to correct to incentivize buyers to keep coming back for AG crudes.
Via the OSP and diffs, obviously.
Yeah.
Yeah. But there's also an element just to think about that, just to take this sort of thought experiment forward. A couple of things, and this is all kind of ex-China as well, because if China comes back into the market very strongly, we'll maybe have a different conversation. But there's two things. The Japanese and the South Koreans have access to SPR crude, and that will dry up in the same way that it should dry up in the US, as in they won't want to release more if there's no need for it.
Mm-hmm.
And probably AG supply is going to be slow to come back, right? So it's also going to be a forced slate shift, if you like, or a forced slow return to the normal AG slate, presumably because actually to get full supply normalization back to 100% of where we were is going to take many months. I mean, I think that's fairly consensus. I think we don't necessarily know what the path is going to be in the next 1 to 3 months in terms of the percentage coming back, but to get to 100% is going to take us a while, I presume.
Yeah, and I think because the SPR stocks is owned by the governments, not by the refiners here, right? So the need to refuel has to come from the government issuing those tenders, and that will be a flat price driven story. So yeah, I think when we look at how fast the recovery of or the replenishment of SPR will take, we will need to see the signals from each of these governments issuing those tenders in the coming weeks, weeks or months, depending on when they have the appetite to do that.
Okay, anything else?
All right,
Did we cover everything?
Iran bomb.
Yeah, okay.
We have one more. I think we should not forget that UAE has exited OPEC in the midst of all this Iran war situation. A few people have asked me, do we think therefore with UAE coming back and having free reign of production, will they flood the market again? Yeah, so what do you think, Neil?
I think they'll try to do assuming everything goes well on Hormuz, because of course they load a lot of oil normally on the western side of it. They will try to max, and that means 1 million to 1.5 million more crude and condensate supply than they were allowed pre-war, so to speak, under the quotas. I don't think that's the most pressing issue. I think the most pressing issue is, what do Chinese imports do? What does global oil demand do? Does it rebound in the same way? What do the Saudis decide to produce? What do the Iraqis want to produce? I even saw unconfirmed tweet this morning that the Iraqis say they might pause their OPEC membership in order to produce max, right? And I stress this is unconfirmed because I haven't found another source for it, but there might be rumblings of that nature that, financially strained economies in the region want to maximize their revenue temporarily. So I think the UAE question is almost like a rounding error at the moment in terms of all the uncertainty we have ahead. And that brings us also to the refinery run rates, because we're talking about end user demand. What do you think about runs, the general state of refining?
Okay, we have seen PAJ data, which is the Petroleum Association of Japan, is 80% utilization rate against operable capacity. So that's actually on the high side. Korea and the rest of Asia seems to be also running at a higher throughput. Even this is before the Strait of Hormuz reopening, having been supplied by SPR and ARB crudes. So I think from now onwards, the refining margins will dictate on whether run rates will further go up in Asia. Independent refiners in China are, on the other hand, at 50% level, which is a 9-year low, even below COVID era levels. The reason is not because of lack of crude, but the margins are horrible for them. China has basically domestic prices capped. So even with Iranian crudes offering at discounts, they are not good enough yet to bring them back into positive margins. We talked about the European heat wave, and this actually happened last year. I still remember our podcast at the time. We were talking about Spain, I believe. When you have very, very hot weather, you will get a lower run rate versus a nameplate capacity. And this is because you are having more light ends produced in the heat, and you heat cooling capacity constraints harder. We also have Exxon's Antwerp 320 KBD refinery potentially shutting down from the 29th of June if the strikes proceed. Moving on to the US, the crude intakes are currently also at max utilization rates. We had some hiccups on Total's Port Arthur and Marathon's Texas City refinery fire, reminding us that there can only be downside risk to operable refining capacities if you push it at the max level. So as a big picture, the good news is with AG crudes coming back to the market, we don't need to depend on US products as much for the rest of the world. But the bad news is US still has drawn down quite a bit on their diesel and mogas inventory. So that has to still resolve in the summer period.
Yeah, I mean, there's lots of I mean, for me, on products generally, there's a lot of difficulty in timing here, because do you want to be long products when crude is falling through the floor, when there's this notion of like, oh, look how many vessels are leaving the region? It feels a bit difficult. But on the other hand, there's actually lots of supportive news outside of this whole issue. There's supportive news, and another one being the Russia diesel ban, or they're expecting or anticipating a Russian diesel ban because of the number of drone strikes on refineries. So a lot of that kind of sounds semi-supportive for things like diesel. Which brings us to you, Abhishek. What do you think? Do you think it's supportive? Would you be long?
Not outright long for sure, Neil, but as you know, distillate has been a stressed barrel because of this Hormuz situation. And definitely a distillate barrel have taken a sigh of relief after all this, but still not out of the wood as we keep hearing about other news like Russian export ban. If that happens, the market has clearly moved away from panic pricing. It was all about Hormuz risk last week and whether EG barrels could move. But this week, the market is pricing some relative easing. However, the flows are still far from those pre-war level. This Iran-US waiver, vessel movement, and the possibility of more AG barrels returning all are bearish for risk premium, but physical flows do not normalize overnight. Standard vessels movement, and most important, the ballast one needs to go back in the Strait of Hormuz to load, and all these things still matter. So the way I see is paper market can remove the fear premium quickly, but the physical market may take a little more longer to fully adjust.
Yeah, and I think we've been over also, like, it seems like we're going to get more of a flood of crude out of the AG before we get the flood of products. So of course, there's probably some laden tankers of products stuck in the strait, but we need their refineries to restart as well. That requires the crude sustainably to restart as well. So it seems like the refinery side is going to be delayed. Plus, there's refineries that are still damaged in the strait to take care of. What about the situation in the west of Suez? How does the supply situation look? What about the ARB picture?
So in Europe, the diesel looks supplied, but it's definitely not loose. Imports we have seen being healthy, and there is no hard shortage signal. But Europe still needs barrel. The problem is looking at the current picture, it's not giving a clean or clear answer. USGC to Europe is still shut. Sikka to Rotterdam via the Cape is still not workable through Cape, I mean. And Yanbu to Rotterdam, though it's positive, but if it remains the only main viable route other than USGC and Sikka being shut, August arrival could still be uneven. So the next key question for Europe is how quickly those stranded barrels clear into Rotterdam and how quickly Kuwait gets export moving again. So that is on the Europe side. US is also a mixed story. Apart from the bearish pressure from the peace deal, inventory builds, which we were mentioning earlier, explain why heating oil cracks and spread softened earlier. But US distillate stock are still not high enough to give the market a big cushion, which we had seen earlier. So diesel can correct, but I would be careful calling it structurally weak unless stock keep building. Also, both heating oil and ice gas oil cracks have bounced in recent days, despite the broader bearish undertone, which tells me there is still some support underneath. And looking at the positioning data, that also fits that cautious view. We have seen ICE Brent net length was cut sharply last week, but that is not the case in distillate. The picture is more split. European gas oil is still seeing inflows, while US heating oil and diesel positioning is broadly flat. That tells me crude risk premium is being taken out, but distillates, especially in the west of Suez, are still holding up better.
Yeah, I mean, it tells you about also the dry powder in either direction, right? So it feels like on the crude side, we almost must have hit a bottom in terms of positioning, whereas you can take more out of the products complex. But it depends on the flow of news, of course, and the way that the supply picture looks. And one of the issues now is the Russia diesel ban, or the potential Russia diesel ban. Where does that fit in? How do you see it in case it would happen?
Yeah, that is a big if. And if Russia moves ahead with the full diesel export ban, that would be clearly supportive for ICE gas oil and wider Atlantic diesel pool, because Russian barrel may not go directly to Europe anymore, but they still supply Brazil, Africa, and Turkey. And if those barrels disappears, replacement demand shifts to India, the AG, and USGC. And this is where the R picture becomes more important. Brazil and Latin already look more attractive from Sikka and Houston rather than Rotterdam. And those barrels become even more relevant if Russian supply is restricted, in my opinion.
Yeah. So what do you think then? Have you got any tried ideas? I mean, it's a very difficult time, of course, but what do you think?
Yeah, even with or without Russia ban, I lean bearish on HOGO. Obviously, the Russia export ban risk is more bullish for ICE gas oil because if Russian diesel are missing, the wider Atlantic pool tightens, and the usual buyers of Russian diesel, as I mentioned, will look out for alternative, and then those Sikka user GC barrel, which would otherwise have option to move Rotterdam, they'll have more competition from Brazil. And even without a confirmed Russian ban, I still think HOGO can correct from these elevated levels. US Gulf MR freight have softened in recent time, but even with the lower freight, Houston to Rotterdam is still not durably open. Rotterdam remains negative in key near-term windows, especially August and September, while LATAM destinations look much more attractive. So even with or without Russia ban, I think I'll lean more bearish on HOGO in west of Suez. In Asia, the tone is relatively softer. Korean exports remain steady. Middle East barrel should slowly return as Hormuz situation normalizes. And China is a wild card. And China remains the big swing factor. China export has not arrived in size yet, but if Beijing loosen controls in July or August, Asian diesel strength can get capped very quickly. And that is why I think east-west spread looks biased lower from here. Asia has enough potential relief to keep the East softer. Europe still needs barrel and not receiving support from the usual arb routes, that will be tricky. And if Russia moves ahead with the diesel export ban, that would be even more supportive for ICE gas oil.
Yeah,
On
sounds
China,
good.
I think we just got a note about that they have allowed for additional exports for July with no like restrictions on destination. Whereas before, it was a G2G discussion, but I think there's already an indication that they are loosening their stance on the exports from July onwards.
Yeah, I would just clarify that though as well, because from what I've seen, the Chinese diesel exports were actually decently strong. It was actually more the jet side, jet and gasoline, where they really reduced the exports. Of course, jet is part of the distillate complex, so it goes in the same direction, but it's more of a jet story. But I think also, seen some early data, it looks like number of crude cargoes heading with jet destination China already troughed several weeks ago and is starting to rise. And I think that's part of a pattern that we should pay attention to. More crude going to China, presumably more runs, presumably more exports of products, and that can move various markets, of course. So there are early signals that the China wildcard is turning around, I would say. What about jet? What do you think on jet on that note, Abhishek?
Jet, I've been bearish for a week now, and again, my view is more bearish than diesel. The key point is that jet had priced a lot of AG disruption risk, and now that Hormuz starts to reopen and Middle East barrel begins to move again, the market has to reassess how tight July and August really are. KPC and other Middle Eastern barrels are the main supply signal. And reports do suggest that Kuwaiti jet has been moving through ship-to-ship transfer outside Hormuz recently. And as more cargo starts moving Europe as the flow normalizes, that is giving a more bearish signal against what we have seen earlier. And this does not mean the market is suddenly flooded, though. But it reduces the risk of hard supply squeeze, which we had seen earlier, especially from east of Suez supply angle. Europe also has more buffers than it had at the start of the disruption. US jet can still act as a relief valve, as you mentioned earlier, has increased the yield and they have some yield flexibility. And other than these changes, the policy flexibility also adds another layer of comfort. And not just the cargo flows, refinery behavior also matters. A jet differential we have seen at the peak of the conflict, and from there it has come off significantly. And with more supply options arriving or returning, refiners may likely trim that jet yields where possible, especially in Europe. That should eventually help rebalance jet, but again, in near term, it looks like jet is not in short supply. In Asia, I'm also not very constructive on jet. Regrade remains weak, which tells us jet is still struggling relative to gas oil. This Iran waiver itself is not a major jet story, but as we are discussing that more crude cargo getting into China, and China, if start exporting in distillate, jet is a bigger story than diesel. So that will have much more bearish pressure if Chinese refiners are allowed to increase jet export in August. And as Jude mentioning, it is already likely that July may happen. That adds another bearish layer to Asian jet and regrade. But until we see those actual export volume, I would treat it as a risk rather than a confirmed supply wave. But given all these conditions where we are in, to me, jet is more weaker than a diesel.
Fair enough. And I think that's almost the way I see gasoline as well. If I'm looking at the gasoline picture on our ARBs, it feels like the tightest picture globally currently is still Houston, and not even Pad 1, because Pad 1 picture looks reasonably normal now. Actually looks like the tightest place is Pad 3. And you can see that that has manifested in both a tight CBOB RBOB basis as well as the TA ARB, the RBOB BBOB spread. So what that has done is price Houston out of a lot of the normal Atlantic Basin destinations, and it allows ARA to look pretty decent as the cheapest source of supply into Tuxpan in Mexico and various other LATAM destinations. So from that perspective, TARB has done enough, and Europe and the US will be presumably allowed to help rebuild itself in terms of the inventory. The yields are going to be a bit of an interesting one because the regrade in the Gulf Coast is still very weak. And, I presume if we see more and more normalization of jet flow out of the AG, that the refiners are also going to say, okay, it's not, we're going to have to switch back to gasoline. We're going to reduce our jet yield eventually. And for gasoline, that means we're going to see it's going to help to produce a less tight picture in the US. In the very short term, Europe looks decently supported. As I said, it looks like the cheapest source of supply into many Atlantic Basin destinations, but that's also started to produce some impact on some of the high octane components. So something like Reformate that's been spending the last week or two strengthening up. And I think that's just the sort of ARB picture into Europe as well. But it doesn't seem like it's a terribly tightly supplied situation in Europe just now either. And one of the things is something like Dangote. Dangote is actually looking very stable. It's running at max. And, I'm sort of mildly bullish EBOB, I suppose, just on the ARB picture, but not that much so. And over in the East, it's sort of the same picture. The East looks well supplied. The East-West spread is quite weak. The East, Singapore currently dominates a lot of the sort of battleground destinations that you might be expecting with ARA in places like East Africa. Plus, you've got the prospect of adding more AG product supply coming out. So the East doesn't look that tight. And then you start to talk about China again. Notionally speaking, there's evidence to suggest that China is going to raise exports again. So I know it doesn't look super supportive East. And the thing that gets me generally not wanting to be too bullish gasoline is that we've seemed like we've hit peak tightness in the US. We've got some solvers coming into place on the crude side. We've got some solvers coming into place from China. Positioning is very strange. There's no shorts on RBOB. And there's the other thing that it seems like from the gas nap perspective, naphtha looks more like crude as a feedstock. It's looking very, very weak. Gas nap is very wide, and that's helping produce a lot of incentives to push naphtha into the gasoline pool. And I think what we need to do on naphtha is to get the petchem crackers telling us that they're going to restart and start to feed in more naphtha, because before we get to that stage, all the market's going to see is more potential for AG supply. So it looks like naphtha is going to stay weak for the time being. So all that doesn't make me super bullish on gasoline, I have to say, in general. All right, guys, anything else?
Well, I wish I could talk about fuel oil, but I didn't have time to prepare.
We'll
do a good one next week for fuel oil.
We'll do some fuel oil. We've just launched our new fuel oil ARBs as well. So that's something that we want to talk about, plug for next week. But we've got an initial plug today. Very good. Thanks very much, guys. Pleasure talking to you. And next week will be episode 100, I think. Is that true?
Yes, indeed.
Okay. So
what
we
a
might
long
all
way
have
we
to
have
come on. Yes, yeah, exactly. So we'll see what we've got to say on episode 100. All right. Happy trading out there. Thanks for listening. See you next week.
Bye, everyone.
Thank you.